I've done it. Every trader has. The pain of taking a small loss feels worse than the risk of a bigger one, until that bigger one arrives. A stop loss isn't there to annoy you. It's there to protect you from yourself. It's the line between strategy and self-destruction. The market doesn't care if you're disciplined, but it punishes those who aren't. When you refuse to take a small loss, you're telling the market that your ego matters more than your account, and the market has a way of humbling egos fast. You ever notice how your worst losses didn't come from bad trades, but from stubborn ones? The ones you refused to close when you should have. That's the cost of pride in this game. It's measured in dollars. I learned this lesson early, and I learned it hard. I once held a losing position far longer than I should have because I was convinced I was right. The chart was telling me the opposite, but I kept ignoring it. When the loss finally hit my account, it was more than just money. It was a message. The market doesn't care about what you think should happen. It only cares about what is happening. Your stop loss is the only thing that keeps that reality from wiping you out. Some traders think using a stop is a sign of weakness, as if it shows a lack of conviction. But the truth is, stop losses are tools of strength. They show that you're willing to admit when you're wrong quickly and without hesitation. You're not in this game to be right. You're here to make money. Being right on a losing trade doesn't pay the bills. Getting out fast does. Respecting your stop is the professional's way of saying, my opinion doesn't matter. Only the market's verdict does. Think of it like this. Every trade you make is just one in a long series. No single trade defines you, but how you handle losses will. The traders who survive for decades aren't the ones who catch every big move. They're the ones who cut their losers before they turn fatal. You don't drown because you fall into the water. You drown because you stay there. The stop loss is your lifeboat. It gets you out before the storm gets worse. Ask yourself, how many times have you watched a small loss turn into a disaster because you didn't follow your plan? You tell yourself, I'll give it just a little more room, but the more room you give it, the less room you leave yourself. Every tick against you drains not only your capital, but your emotional energy. Before you know it, you're not trading your system anymore. You're trading your emotions. And emotions have no edge. When you respect your stop, you're not just protecting money, you're protecting your mindset. Small losses are part of the game. They're like the cost of admission. But big losses, they change how you see the market, how you see yourself. They make you fearful, hesitant, reactive. You start avoiding good setups because you're still haunted by the pain of that one big hit. That's why stops aren't optional. They're essential. They allow you to reset quickly, without emotional baggage. The professionals always plan their exits before they enter. They know exactly where they'll get out if they're wrong. That's not pessimism. It's discipline. The amateur, on the other hand, thinks he can decide his stop after the trade starts moving. That's like deciding where to build a parachute after you've jumped. You can't protect yourself mid-fall. The protection must already be in place. And remember, a stop loss doesn't mean the trade failed. It means the trade didn't work this time. There's a difference. A failed trade is one where you ignored your own rules, moved your stops, and let emotion take the wheel. A trade that hits its stop according to plan is a successful execution, even if it loses money. Because your job isn't to avoid losses, it's to control them. Some traders use mental stops, promising themselves they'll exit when the price hits a certain level. But the moment it does, they freeze. They rationalize, they wait. A hard stop doesn't let you negotiate, it enforces your discipline automatically. It's your safety net in a game that rarely gives second chances. The most dangerous phrase in trading is, I'll just hold a little longer. Those words have buried more traders than any bad setup ever could. You have to learn to cut without emotion, to trust the logic of your plan over the voice in your head. Because that voice will lie. It will tell you it's just a dip, just noise, just temporary. But the chart tells the truth. Price is truth. And your stop loss is how you respect the truth. When you start treating stop losses as part of your edge, not as an inconvenience, your trading begins to change. You start thinking in probabilities instead of hopes. You start planning for survival, not perfection. You stop trying to win every battle and start focusing on winning the war. The traders who last are the ones who master the art of losing well. Because in this business, you don't get to choose when you'll be wrong. You only get to choose how wrong you'll let yourself be. So when that stop hits, don't fight it, don't flinch, and don't curse the market. That line was there for a reason. It's your insurance policy, your proof of discipline, your ticket to stay in the game. Focus on capital preservation before profit. That sounds like something every trader nods along to, but very few truly live by. Most people come into the market thinking about how much they can make, not how much they can lose. They dream of profits, charts, fast wins, and freedom. But they forget the one principle that keeps traders alive. If you lose your capital, you lose your opportunity. The market rewards the man who protects his stake first and seeks profit second. Every professional understands this. Every amateur learns it the hard way. You can have the sharpest analysis, the most advanced indicators, and still lose everything if you don't protect your base. The stock market, the forex market, the crypto market, whatever you trade, they all exist to take money from the careless and hand it to the cautious. The careless chase returns, the cautious defend their resources. Because trading isn't about hitting home runs. It's about staying in the game long enough to catch the right pitch. Ask yourself, how many times have you made money, only to give it back in the next few trades? That's not bad luck, that's poor capital management. You were focused on making profits instead of keeping what you already earned. Every great trader I've known, and every great story in the market's history, comes down to survival. You don't need to make money every day. You need to not lose too much on your bad days. If you can master that, the rest takes care of itself. When you think of capital preservation, think of it as your oxygen. You don't notice it when you have enough, but the moment it runs out, nothing else matters. Traders who lose sight of this start taking reckless risks after a few wins. They double down, they over-leverage, they believe they're invincible. And that's when the market reminds them who's boss. A single bad position can undo weeks or months of discipline. One undisciplined trade can take you out of the game entirely. I used to trade with too much size because I was confident in my setup. The chart looked perfect, the volume confirmed, the price was lining up exactly the way I'd seen before. But the market doesn't owe you consistency. It only offers opportunity, and that opportunity is never guaranteed. That perfect setup turned against me. And because I had risked too much, it hit harder than it should have. That's when I realized that trading is not about being right. It's about staying solvent. The best traders are not the best predictors, they're the best survivors. When you focus on preservation, you begin to see the market differently. You stop asking, how much can I make? And start asking, how much can I afford to risk? That small shift changes everything. You start thinking in terms of percentages, not emotions. You stop chasing trades that don't meet your risk criteria. You begin to trade like a business owner, not a gambler. Every position becomes an investment in probability, not a shot in the dark. Capital preservation is about control. Control of your exposure, your emotions, and your expectations. You set your stop losses before you trade. You size your positions according to risk, not greed. You protect your gains by locking in profits gradually instead of trying to squeeze every last cent out of the market. You start to understand that your account balance is your weapon, and every trade that goes against you dulls its edge. The market doesn't destroy people who lose money. It destroys those who can't stop losing it. It's the lack of restraint that kills, not the act of losing itself. If you lose small and consistently manage risk, you'll always have the chance to strike again. But if you go for the big score every time, sooner or later, you'll hit the wall. That's why the pros say take care of your losses, and the profits will take care of themselves. Do you ever notice how new traders talk about doubling their accounts, while experienced traders talk about protecting theirs? That's wisdom earned through pain. Once you've watched your equity curve fall off a cliff because you didn't respect your limits, you realize that the game isn't about making money fast. It's about avoiding the kind of losses that put you out of business. Your capital is your inventory, your seed, your lifeblood. Without it, even the best strategies are useless. There's a reason I always say, the first rule of trading is to live to trade another day. The market will always be there. Opportunities will always come back. What doesn't come back easily is capital lost through recklessness. Preservation is patience in disguise. It's knowing that you don't need to chase every setup, that missing one trade won't hurt you, but blowing your account will. Capital preservation also means preserving your mental capital. Every big loss doesn't just reduce your account. It damages your confidence. It changes the way you see the next trade. Suddenly, your judgment becomes cloudy, your emotions louder. You start hesitating where you should act and acting where you should wait. The mind is part of your capital too. Protect it by keeping your losses small and your risk contained. This principle ties directly into discipline. A trader who respects his capital doesn't get reckless after a winning streak. He doesn't overtrade because he's bored. He doesn't revenge trade after a loss. He understands that the goal isn't excitement, it's endurance. The amateur wants action, the professional wants longevity. If you build your approach around preservation, your trading style naturally becomes more strategic. You start looking for asymmetric setups, trades where the potential reward far outweighs the risk. You stop trying to prove yourself to the market. You stop forcing trades for ego. You focus on consistency, not excitement, and over time, that consistency compounds into profit, because every dollar you protect is a dollar that can work for you tomorrow. Every trade you skip because the risk was too high is a victory in itself. Every time you take a small, controlled loss, you're paying tuition to the market wisely instead of gambling it away. Preservation is not passive, it's active discipline. It's the art of saying no when every part of you wants to say yes. And the strange thing is, once you make preservation your priority, profits tend to follow. Because when you stop fearing losses, you stop forcing trades. When you stop forcing trades, your edge starts to shine. You see the market clearly, without desperation. You let opportunity come to you instead of chasing it. That's when trading starts to feel less like fighting a storm and more like sailing with the wind. So before you ever think about how much you can make, think about how much you can keep. Protect what you have like it's your last dollar, because one day it might be. Learn to read yourself before you read the market. Every trader wants to master charts, patterns, and indicators, but the real battlefield isn't on the screen. It's in your own mind. The market doesn't beat you, you beat yourself. You can have the best analysis, perfect setups, and still lose if your emotions take the wheel. The difference between the professional and the amateur isn't knowledge. It's control. The professional studies his reactions as closely as he studies price action. The amateur blames the market when things go wrong. Most people come into trading thinking they're fighting against other traders. But that's not true. You're fighting against your own impulses. Fear, greed, impatience, doubt, overconfidence. Those emotions are always there, waiting to sabotage your decisions the moment you let your guard down. The chart is just a mirror. It reflects what's going on inside you. When you feel anxious, every tick against you feels like an attack. When you feel greedy, every small win feels like a disappointment. That's why learning to read yourself is more important than learning to read the market. Ask yourself, how do you feel when you lose a trade? Do you accept it? Or do you start looking for a quick rebound just to get even? That's revenge trading, one of the most destructive habits in this game. It's not about the setup anymore. It's about ego. You want to erase the loss to prove you're right. But the market doesn't care about right or wrong. It only cares about discipline. Every time you let emotion dictate a trade, you're stepping away from reason and into chaos. I've seen traders blow up accounts, not because they didn't understand the market, but because they didn't understand themselves. They'd win a few trades, get confident, start taking bigger risks, then lose it all in one bad streak. They thought they were being bold. Really, they were being emotional. You can't build consistency when your mindset swings with your balance. You have to learn to stay steady, whether you're up or down. The market will always test your temperament before it rewards your technique. When I was younger, I thought trading was all about strategy. I'd spend nights studying patterns, reading price action, watching volume. But it wasn't until I started studying my own behavior that things changed. I realized my biggest losses came not from bad setups, but from impatience. You know, there's a certain rhythm to the market that only reveals itself when you've lost enough, waited enough, and watched enough. Most traders never get to that point. They're too busy trying to beat the market instead of listening to it. Today, I want to share 5-day trading tips you must know if you ever hope to play this game like a professional speculator instead of a hopeful gambler. You might remember in the previous video on Rule No. 1 to catch big moves, we talked about how patience and timing create the real opportunities in the market. Well, this time, we'll dig into the mechanics, the habits and observations that make that patience pay off. Now, the first thing I've learned about trading is this: the market doesn't reward effort. It rewards observation. You can stare at those charts for 10 hours a day, but if you're not seeing what matters, you're wasting your time. Have you ever noticed how the same setups repeat themselves again and again? It's like the market has a limited vocabulary. It keeps using the same words, just in different combinations. My first tip is to trade only when the market tells you something clear. Don't invent trades out of boredom. Don't force a setup because you've been sitting idle too long. The hardest thing in trading is not taking action. It's waiting for the right action. That's where your money is made, by waiting. Most people think day trading is all about fast fingers and faster decisions. They couldn't be more wrong. Speed means nothing without clarity. I used to sit in the bucket shops in my younger years, watching the tape run across the board. I didn't trade every wiggle or every uptick. I waited for confirmation, when price action and volume spoke the same language. So ask yourself, when you stare at that screen, are you reacting or are you reading? Because one of those leads to profits and the other leads to pain. The second tip is one that cost me more than I like to admit: respect your stop losses. When a trade turns against you, don't argue with it. The market doesn't care about your opinion. I've seen more traders go broke defending a bad position than chasing a good one. The key is survival, protecting your capital so you can fight another day. You see, your job isn't to be right, it's to make money, and making money requires admitting when you're wrong. That's something pride won't let most traders do. But the market has a way of humbling every proud man. Ever held onto a losing trade, hoping it would turn? We all have. But here's the truth: hope is not a trading strategy. Now, let's talk about tip number 3, trade with the path of least resistance. The market moves in waves, and your job is to ride the tide, not swim against it. If the trend is up, look for long setups. If it's down, look for shorts. Simple, right? Yet, most traders do the opposite. They want to pick tops and bottoms, trying to call the turn. That's a fool's game. The big money, even in day trading, is made in the middle of the move, not at the edges. You'll remember how in our last discussion about Rule No. 1 to catch big moves, we talked about recognizing the start of momentum before it becomes obvious. Well, the same principle applies intraday. Follow strength, not weakness. If a stock is leading the sector, there's a reason. Let the leaders lead you, and don't fight the tape. And while we're here, let me remind you of something simple that most traders forget. The market doesn't care about you. It doesn't owe you a winning trade because you studied hard or because you've lost 3 in a row. The market is impersonal. It rewards discipline, not desire. That's why you must learn to trade like a machine with the instincts of a man. It sounds like a contradiction, doesn't it? But that's what real trading is. A balance between control and instinct, between analysis and intuition. Tell me, do you ever feel that tension when you're about to pull the trigger? That's the moment where most traders fail. They either freeze or they act impulsively. The professionals, They've trained their impulses to align with their plan. Tip number 4 is simple but deadly important. Keep your losses small and your winners free to run. This is not just a rule, it's survival. When I was young, I used to scalp every small move, thinking that frequent profits meant safety. It took me years to learn that one big loss wipes out 10 small wins. The mathematics of trading is merciless. You can't let your ego write checks your account can't cash. When the market gives you profit, let it prove itself. Trail your stop, scale out if you must, but don't kill a trade before it matures. The crowd always cuts winners short because they're afraid to lose what they've made. But the professional knows. The only real protection comes from following strength and staying with it until the action changes. And that brings us to the 5th and final tip for today. Learn to read yourself before you read the market. Every trader wants to master charts, indicators, and setups. But the hardest chart to read is the one inside your own head. The emotions, fear, greed, impatience. Those are your real opponents. You can't outthink the market until you outthink yourself. You ever notice how the moment you double your position size, your decision-making changes? Suddenly, you're not reading the chart anymore. You're reading your P&L. That's the danger zone. The best trades come when your mind is calm, detached, and focused on probabilities, not outcomes. The truth is, trading is not about predicting. It's about preparing. You prepare by studying price action, by keeping records, by reviewing your own behavior as much as the market's. Every loss has a lesson. Every win hides a mistake. The market is always teaching. You just have to be humble enough to listen. Remember what I said about catching big moves. The opportunity always starts small. It begins with preparation, observation, and discipline. You can't catch the big wave if you're distracted by every ripple. Now, let's be honest with ourselves. Are you trading your plan, or are you chasing your emotions? Do you even have a plan, or are you making it up as you go along? These are uncomfortable questions, but they're the ones that build longevity. Most traders want excitement. The professionals want consistency. Day trading isn't about fireworks. It's about execution. It's about doing the same right thing over and over until the odds tip in your favor. And that's the quiet truth behind all 5 of these tips. They're not about the market. They're about you, your patience, your courage, your ability to sit still when others can't, to strike only when the odds are real. You see, the charts are mirrors. They reflect the crowd, and if you look closely enough, they reflect you too. The market is nothing more than human nature on display, and the trader who learns to read that nature, both in others and himself, will always have the upper hand. Because in the end, trading isn't a game of prediction. It's a game of reaction. The tape doesn't lie, but men do, especially to themselves. When you can stop lying to yourself about what you see on that screen, when you can truly read the market as it is, not as you wish it to be, then you'll understand what separates the gambler from the speculator, the dreamer from the operator. Trade only when the market gives a clear signal. It sounds simple, almost too simple, but that one rule separates the gambler from the professional. Most traders lose money not because they lack intelligence, but because they lack restraint. They trade because they want action, not because the market is truly offering opportunity. The truth is, the market speaks in whispers. It rarely shouts. You have to learn to wait, to listen, to recognize when those whispers turn into clear, decisive movement. And when it does, you act, but never before. You see, the crowd wants certainty. They want the market to tell them what's going to happen next. But the market doesn't hand out guarantees. It only offers probabilities. That's why the trader's job is to wait until those probabilities stack in his favor. You might spend hours, even days, watching price move sideways, flickering up and down, teasing you with false starts. That's the market's way of testing your discipline. Can you sit there, calm, patient, and unmoved, while others get lured into noise? Or do you feel that urge to click the button, just to do something? That urge is the death of good trading. When I first started speculating, I thought being active meant being smart. I thought the more trades I placed, the more opportunities I was creating. I was wrong. Every unnecessary trade I took chipped away at my capital and my confidence. Eventually, I learned that waiting was the real work. It's not glamorous. It's not exciting. But the best trades always begin with boredom. The chart looks quiet, the tape is steady, volume is building slowly, and then, suddenly, the market tips its hand. A breakout forms, a resistance gives way, a trend confirms itself. That's your moment. That's your signal. So what does a clear signal look like? It's a moment when price, volume, and momentum all align in harmony. It's not just a pattern, it's a message. Price action tells you the direction. Volume tells you conviction. Momentum tells you strength. When all three speak the same language, that's the market giving you permission to act. But if even one of them disagrees, step back. The professionals wait for alignment. The amateurs guess, and guessing has no place in this business. Ask yourself, how often have you taken a trade just because you were tired of waiting? How many times did you convince yourself that a maybe setup was good enough? Those maybe trades are what drain your account, slowly but surely. The market doesn't punish impatience immediately. It lures you in with small wins, then takes it all back in one sharp move. That's how traders learn the hard way that clarity is everything. When the market is unclear, your job is to do nothing. That's the hardest work of all. The discipline to not trade is the first step toward mastery. A clear signal doesn't mean perfection. It means the odds are tilted, not random. You're not waiting for certainty, you're waiting for an edge. That edge might be a breakout from a well-defined range, a clean pullback in a strong trend, or a surge in volume confirming a direction. Whatever your system is, your signal should be precise enough that there's no hesitation when it appears. Clarity in trading also means clarity in your plan. If your rules are vague, your decisions will be emotional. You should know exactly what you're waiting for. What setup, what pattern, what confirmation. That way, when it shows up, you won't question it. Most traders lose because they don't define what a clear signal is for them. They keep improvising. They switch indicators, change timeframes, tweak rules mid-trade. That's not trading, that's guessing with technical excuses. The real traders act like snipers. They wait, they prepare, and when the moment comes, they pull the trigger without hesitation. Remember this, the market rewards patience, but it pays in bursts. You might wait 3 hours for one perfect entry, and that one trade could make your day. But you'll never get there if you waste your ammunition on every flicker of movement. You can't catch every move. You're not supposed to. The professional only trades when he recognizes his setup, his pattern, his signal. Everything else is noise. I've seen countless traders destroy their edge by forcing trades during low-volume chop, thinking they're staying active. There's a difference between being active and being productive. The market doesn't care how many trades you make. It only cares how many right trades you make. And right trades come from clear signals, not constant action. The irony is, the clearer the signal, the less time you'll have to think. That's why preparation matters. You prepare before the market opens. Mark your levels, study your watch list, identify your triggers. Then, when the signal comes, you act instantly because you already did the thinking beforehand. You're not reacting, you're executing. That's what separates trading from guessing. Every professional trader I've ever known says the same thing in different words. Wet for your pitch. In baseball, you don't swing at every ball. You wait for the one that's in your zone. Trading is no different. You'll see 100 setups a day, but only a handful deserve your money. Your goal is not to catch every move, it's to catch the right moves. When you wait for clarity, you trade with confidence. You know where your stop is, where your target is, and what the signal means. There's no guessing, no second guessing, no emotional roller coaster. You win or lose based on your plan, not your mood. And that consistency is what builds real wealth over time. Because every time you trade without a clear signal, you're not just risking money, you're damaging discipline. And discipline is the only real asset you have in this game. The market can take your cash, but if you lose discipline, you've already lost the battle. So ask yourself, when you look at that chart, is the market really showing you something, Or are you just looking for an excuse to trade? The answer to that question determines everything about your future as a trader. Respect your stop losses. Never argue with price. That single rule has saved more fortunes than any secret strategy or clever indicator ever could. It sounds simple, but most traders fail to live by it. They believe they can outthink the market, that somehow the next tick will turn things around. But the market doesn't bend to your beliefs. It moves the way it wants to, when it wants to, and for reasons that often make no sense in the moment. That's why you must respect your stop loss as if it were the law of survival. Because in trading it is. Every trader enters a position with hope. You see a setup, you make your plan, you press the button, and for a brief moment, it feels like you're in control. But the moment the market turns against you, that illusion fades. Now you're not a trader anymore. You're a negotiator, trying to bargain with price. You tell yourself, it'll bounce. Or, it's just a pullback. You move your stop a little lower, maybe delete it altogether, convincing yourself that you're being patient. But what you're really doing is digging a deeper hole.